All right. So today we are looking at accounting for materials. We're going to utilize the double entry rules. Okay. The rules that we must remember specifically are for assets. Increase in an asset, you debit. So assets increase with debit and they reduce with credit. Um, I'm recording is yes. Liabilities increase with credit and they decrease with debit. And then, yeah, even expenses increase with debit and reduce with credit. So we're going to apply these double entry rules here. Okay. So remember the stores account. Okay, the stores account is like an asset account. Okay, meaning anytime you're buying raw materials or any direct materials or indirect materials, okay, they will increase. Increase is it's a debit entry. Okay, if any materials are moving from the stores account, you take it like a decrease in an asset, and you're going to credit. Okay, yes. So materials coming in, either direct or indirect, you debit. Materials going out, you credit. Okay, just remember those two things, especially for the stores account. All right. Yes. Then remember important points. We've got raw materials inventory. Okay. These are the this is the material you buy which you need to make your finished products. Okay. You've got your accounts payable. These are your suppliers. In case you buy raw materials from them on credit, they become your accounts payable, meaning you're owing. These are people who you owe. Okay. Work in progress. It means materials have been used, but they're not. They haven't. You haven't finished making the finished product. Okay. You're still in the process of making the finished product. Okay. So work in progress. It's still under the asset account because you're still dealing with the raw materials. Okay. Finished goods, these are the completed goods. Okay. Finished goods, the completed goods. Cost of goods sold, as we say, these are the goods that have been sold, and you want to know the cost. All right. So here are some transactions and the journal entries attached to them. Then we'll look at an example. Whenever you purchase materials, okay, remember I said the stores account is like an asset account. So whenever you purchase raw materials, it's like an increase in your asset. Okay, that's why we are debiting here. You debit the stores, debit stores account. Okay, it's like now raw materials have come in, so it's increasing. Okay, so that's why we debit. Then if you don't pay any money, it means you are owing someone. So an increase in a liability, you credit. Okay, yes. If you pay money, since money is coming out of your pocket, money is an asset, cash is an asset, a decrease in an asset, you credit. Okay? Yes. Next, the issue of materials to production. Okay, so here it's just like raw materials, they are now going into start being used. Okay, so the work in progress account is also an asset account. Okay, so think of it like this here. You got stores, this is where the raw materials come in. You've got work in progress, and you've got finished goods. Okay, so when you purchase materials, initially when you purchase materials, you record them here in the stores. Okay, on the debit side. Now, when you want to use these materials have to go from stores to work in progress there. Okay, so when they move away from stores, it's like stores, there's a reduction in the asset of stores. Okay, that's why we'll create stores. All right, and then work in progress has now acquired a new asset in form of raw materials. So you're going to debit work in progress. Have you seen? Mhm. So this is the journal entry that's happening here. Okay, you're going to debit work in progress, increase in an asset. Okay, and then you credit stores. Okay, or even raw materials inventory. But to make life easy, let's just call it stores. Okay, stores account same as the raw materials inventory. Okay, so the materials have moved from stores. So we credit stores, goes into work in progress. Once they're used up in work in progress, then they move out of this account. Okay, they move out of this account and they go to finished goods. Okay, each of these accounts are asset accounts. Okay, the asset is inventory. Okay, so when inventory is moving from one account, when inventory enters an account, you debit that account. When it moves from one asset account to the other one, you have to credit one asset account and debit the other one. Okay, because one account is increasing, one is decreasing. Okay. Mhm. So for stores, for issue of materials production, that's what's happening here. Okay. And as you can see here, when production is completed, all right. So when production is completed, the materials are leaving the work in progress account. That's why we're crediting. And they're now going to finished goods. That's why you're debiting. Okay. So work in progress, since the materials are moving out of there, so think of it as a decrease in an asset, you credit. Then finished goods, since we're acquiring um inventory, basically the raw materials which are now been worked on and now they're finished. They're now ready to be sold. So it's the finished goods account is getting inventory. That's why we're debiting. It's increasing. When finished goods are sold, remember money is coming into your pocket. So you debit cash. Cash is an asset. Increase in an asset, you debit. Then you credit sales revenue. Okay. Remember, according to entry rules, sales revenue increases with credit. Revenue is part of income. Okay. Yes. So you've got in cash and your revenue has increased. Okay. That's when you have sold goods. Okay. Then you've got also the recording of cost of goods sold. Cost of goods sold is an expense. Okay. Because remember here from the finished goods, these goods are going to be sold. Okay. And so they're going to move here under cost of goods sold here. Okay, they come out from the finished goods inventory account, so you credit finished goods account. Okay, for those that have been sold. Okay, these which we're crediting here, the ones that have sold. It's not all the finished goods, only the ones that have been sold. Okay, you credit, and then you also get their cost. Okay, they are basically valued at cost. So those that are sold, you value them at their cost. Okay, so we're going to look at an example. Okay, we're going to look at an example and see our journal entries. Okay, so at 1st January 2015, the total value of items held in stock was 50 million. During the month end, the following transactions were occurred. Okay, so we've got each transaction here: materials purchased from suppliers, materials returned, materials purchased for cash, direct materials issued to production, materials issued to maintenance services, and direct materials returned to stores for production. So enter each transaction in the store's account, balancing off the account. Okay. So before we do that, before we balance off the account, we need to know the journal entries. Okay. Yes. So the first one, we purchase materials from suppliers on credit. What do you think for the journal entry will be? Mm, the amount that we're owing. Because we've bought it on credit. We bought it on credit. So I'll put it like this here: debit, credit. Okay, so for transaction one, we're going to debit stores, our inventory account. We're going to debit it 60 million. Then we're going to credit accounts payable. Since we haven't paid money for this, so we are owing. Okay, we are owing. So we're going to credit accounts payable. And remember, increase in a liability, you credit. So we're going to credit accounts payable 60 million. Any question? Okay, second transaction. Materials returned to suppliers. So, yes. Uh-huh. And what are we debiting? Reducing. Yes. Reduction in a liability, you debit. Okay. Especially if this is from the same supply. Okay. Since these goods, obviously, they were not good, they were damaged. So what we're owing the supplier must reduce. Okay. And these goods are coming out of the store's account. So we credit stores 3. Okay, the next one's materials purchased for cash. We debit stores because we're acquiring new inventory. Increase in an asset, we debit. So stores, we debit 8. Then what are we crediting? Mm-mm. Cash, since we have paid for it this time. Okay. Okay, transaction 4, direct materials issued to production. Uh-huh. Because it's moving from the stores to now, where is it moving to? Yes, so you put a work in progress. Okay, work in progress. Mm. So you can call it production, work in progress, whichever. Okay. Also, it's an asset account, so it's increased. That's why we debit. Then stores, since these materials have left stores, so we credit. It's like a decreased asset. Okay. Number 5, materials issued to maintenance services department. Mm-hmm. It goes into production overheads. Um, so you go production overheads. Okay, because remember, maintenance, the maintenance department, they they don't take, they don't make this product. Okay, they don't take part in making the project. They help the production departments. All right. So these, yeah. So production overheads we credit 20. So you can put production overheads maintenance in brackets, okay, so that you know where it's going. Uh, then we credit, yes. Then stores we are crediting because it's leaving stores going to production. Because remember, in stores, you can get direct materials. These are the materials used for making the finished product. Or you can get indirect materials. These are goods for the supporting departments like cleaning utilities, maybe for making need oil for the machines, you know. Mm. Okay, so production overheads in brackets we put maintenance. Okay. Then finally, direct materials returned to stores from production. Uh-huh. Yes. So you have seen how easy it is. Mhm. You should send me them. I'll help you. I'll help you answer them out. Mhm. It's the same thing. It's the same concept. Okay. So here's the account, the store's account. Okay. The journal entries are in correspondence with that. So let me just bring it here. Okay. Okay. So as you can see here, we've got the first entry. Here we've got our balance brought forward because remember in the question it told us that they told us here that the total value of items held in stock was 50 million. Okay. So yes, you've already got 50 million. This is your balance brought forward. Okay. So this 60 million debit entry, it comes here under creditors here. Okay. Here we put accounts payable, but you can also put creditors. Okay. Mhm. Then also this 8 million here, there's 8,000 for cash. It was for this general entry where we debited stores 8 and we credited cash 8. Yes. Then this returns from work in progress. Okay, it's here, this one here. Mm. So is this 4,000 here? Okay, these are the debit entries for stores. Then the remaining ones are the credit entries. Okay, like we've got for work in progress. This one 55,000. Here it is, January 24. Production overhead 20,000. As you can see, stores is credit side. Work in progress again. So stores credit. Returns to suppliers is this one here. What do we do for returns to suppliers? This 3,000. Here under accounts payable, you can also put returns to suppliers. Okay, three. Then you remember how to balance off okay for, and let's just illustrate for those people who might not know when watching this video. So you total up both debit side and credit side. Okay. So here the debit side it's got a higher number, 122,000. 50 plus 60, 110,000 plus 12,000, 122,000. So you put the total amount on both sides. So this balance carried down. Okay. It's when you subtract 122,000, this figure, 122,000 minus this total here. 55 plus 20, that is 75. 75 plus 3, 78,000. So 122,000 minus 78,000 gives us this 44,000 here. Yes. 122,000 minus 78,000 gives us our balance carried down here. And then in the next month, it becomes your balance brought down 44,000. Okay. Yes.